Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. In a very disappointing development for Shanghai residents, after 2 days of no official new COVID-19 cases in the general public, on Monday, Shanghai authorities announced the discovery of 58 new infections outside of quarantined population. What is worse, the cases were discovered in low-risk zones, which are supposed to be, low risk. Areas are labelled low risk if in principle new cases have not been discovered for 2 weeks. This development not only resets the clock in terms of Shanghai moving towards going back to something approaching normal, but also means that authorities may reintroduce restrictions on low risk areas, many of which have only just recently started seeing easing. The only silver lining, if the trends behind official numbers are generally representative of actual trends, is that yesterday, Sunday, new cases declined for the 9th straight day, dropping 6.8% to 7,333 in the previous 24 hours, according to official data released today. Symptomatic cases are down 7.7% to 727, and the death toll has decreased too. Over the last 48 hours, Shanghai authorities allowed another 1,188 factories to join the first batch of 666 factories to start back up with production under the so-called closed-loop system, where workers are required to remain on site. We should note that 3 sixes is an auspicious number for many Chinese, so 666 carries a very different connotation in China than it does in the West or Latin America. Meanwhile, in Beijing, restrictions continue to tighten in large parts of the capital, with an order yesterday, Sunday, that restaurants must close and only offer takeaway services. Thus, eateries have joined the tens of thousands of other businesses in the city and others to shoulder the cost of restrictions with these now years-long disruptions. After the Labor Day holiday period finishes this Thursday, Beijing residents will be required to provide proof of a negative PCR test result taken within the previous 7 days in order to use public transportation and enter most buildings, public or private. In Hangzhou, the provincial capital of Zhejiang, a wealthy province which hugs Shanghai, residents must provide proof of a negative PCR test taken within the previous 48 hours in order to enter most places. Indeed, while our attention is on Shanghai and Beijing, we remember that restrictions and lockdowns are currently affecting dozens of other Chinese cities too, as well as hundreds of millions of its residents. Okay, next up, over the weekend, the Caixin China General Manufacturing Purchasing Managers Index, PMI, which gives a snapshot of China's manufacturing sector using alternative data to official data from the Beijing-based National Bureau of Statistics, published China's manufacturing activity data for April. And it was not good. According to the report, China's PMI in April fell to 46, the lowest reading since February of 2020, when large parts of the country shut down for the Wuhan outbreak, from an already concerning 48.1 in March of this year. Indeed, after February 2020, this is the second steepest rate of decline since the survey began in 2004. It wasn't even this bad during the global financial crisis. We remember that a reading below 50 signals a contraction in activity, while a number above 50 signals an expansion. We don't need 3 guesses to know what was driving the steep decline in April. Wang Zhe, a senior economist at Caixin Insight Group, expressed with the publication of the data, quote, "Continuous regional COVID outbreaks in March disrupted production and logistics in manufacturing and impacted demand. Supply shrank, demand was under pressure, external demand deteriorated, supply chains were disrupted, delivery times were prolonged, backlogs of work grew, workers found it difficult to return to their jobs, inflationary pressures lingered, and market confidence remained below the long-term average." end quote. The accompanying report observes that many manufacturers found that they needed longer to deliver their products because of lockdowns, travel restrictions, and limited raw material availability. Some companies surveyed said clients cancelled orders because of difficulties in production and shipping, though, quote, companies in the survey were generally optimistic that production would rebound over the next 12 months, end quote. Next up, according to a statement released in recent days by the State Council's Customs Tariff Commission, China will suspend import tariffs on coal for 11 months until March the 31st, 2023. Currently, the tax on coal imports is around 3 to 6%, depending on the type of coal and the country of origin. In March, prices of coal imports in the People's Republic of China were over 77% higher year on year, and coal imports were down 39.9% compared with a year earlier. The tax suspension is an effort to take some of the import costs of coal to maintain supply amid a global surge in coal prices. While China mines a lot of coal domestically, it relies on imports for high-quality coal types. While the move is likely to have some effects, analysts predict that they will be very modest at best. China's largest coal supplier is Indonesia, which already enjoys zero tariff access to Chinese markets. A lot of Russian coal is restricted by disruptions. Indeed, much of the surge in prices is from the conflict in Europe, which has caused many EU markets to abandon Russian coal and turn to Australia, Indonesia, and others. And of course, coal will see a resurgence in China in the next few years. We remember last week that the State Council laid out a plan to boost domestic production capacity by 300 tons in 2022, an increase of about 7%, and this trend will continue into the future. Now, this brings us to China's housing market. Quickly, guys, if you're enjoying the content, don't forget to hit the like button, and if you want to go that extra mile and try and help keep China Update sustainable, financially sustainable, keep the channel going, my Patreon, Buy Me a Coffee, and crypto links are in the description below. As always, everybody, thank you so much for the ongoing support. Okay, last up, like I said, let's look at the ongoing property crisis in the PRC. In past videos, we discussed the trend of local governments across the country in recent months to loosen restrictions on buying homes, that is, demand-side promotion, as pressure was mounting on growth and local government budgets. Even before the Shanghai lockdown, local authorities have been making it easier for households to get a mortgage and promoted mergers and acquisitions in the real estate sector with state actors. And as we have also seen in previous videos, these moves by local governments have had limited to little to no effect on reversing the housing crisis on either the demand side or the supply side. Despite 28 cities rolling out favorable mortgage policies for home buyers in the first quarter of this year, and 15 cities relaxing curbs on purchasing or offering subsidies, in March, contracted sales by the 100 largest property developers of the country fell 52.7% by value year on year. The April data, which should be out soon, is not expected to be much better. Since March, banks in more than 100 cities have also cut mortgage rates. Now it seems like the central government is also throwing in the towel, with the Politburo, China's top decision-making body after the Politburo Standing Committee, last Friday, straight up calling on local governments to loosen their grip on how developers use revenue from property pre-sales, essentially telling local governments to support local housing construction and buying, but still not going so far as to abandon the 3 red lines policy introduced in 2020. At the Friday meeting, the Politburo said it supports local governments, quote, adjusting real estate policies based on local conditions, end quote. This is a big deal for the property sector, especially the loosening of restrictions on pre-sales revenue. While the Politburo meeting did not mention any specific policies, loosening measures could include allowing property developers to withdraw much more money during the construction phase. However, Beijing may well have opened a Pandora's box with the prematurely reversed deleveraging campaign of the housing market, and analysts are still deeply concerned, arguing that Friday's support measures will not be enough to support the crisis-hit industry. industry, not to mention the issues with investor and consumer confidence. Quote, "It is difficult to uplift real estate market sentiment without policy adjustments at the national level, such as relaxing the 3 red line policy or direct funding to property companies." End quote. And of course, this is all before factoring in the crippling disruptions of the latest round of lockdowns. The real estate markets in cities in lockdown are basically frozen, and in other parts of the country investment is greatly reduced as economic actors cannot price in the uncertainty of lockdown risk. We will continue our examination of the ongoing housing crisis more in tomorrow's video. See you then.